All right, everyone. Today, we're unpacking a really deep analysis from BGVC on a protocol that's not just part of a trend, it's building a core piece of financial infrastructure on the blockchain. We're talking about Pendle. Let's break down how this thing is set to change the future of finance.
So, let's start with this one simple question, but it's a powerful one. It gets right to the heart of a massive, massive challenge in decentralized finance, or DeFi. And honestly, the answer to this is what could finally push this volatile new market into a truly mature, stable financial system.
You know the foundational protocols of DeFi, right? The big lending platforms like Aave and Compound. They're incredible, but they come with a catch. The yields they offer are all over the place, constantly fluctuating. And that volatility makes any kind of long-term financial planning, well, pretty much impossible. And this unpredictability, it creates huge headaches for literally everyone involved. If you're a yield farmer, you see these amazing rates today, but you have no way to lock them in for tomorrow. If you're a borrower, you're constantly exposed to costs that could spike at any moment. And if you're a DAO or a big institution trying to manage a treasury, good luck trying to build a stable budget. It's a mess. But the problem here runs so much deeper. It's not just about the yield being volatile. It's about a massive, fundamental piece of financial infrastructure that was just missing. I mean, to put this in perspective, traditional finance has a $400 trillion market for interest rate derivatives to solve this exact problem. Before Pendle, DeFi had a giant void, no way to trade, hedge, or even figure out what future yield was worth.
So, how in the world do you solve a problem that big? Well, Pendle's solution is a concept called yield tokenization. And it's not just clever, it's genuinely elegant. It's a way to create entirely new markets from assets that already exist.
So here's how it works. Pendle takes a yield-bearing asset, let's say staked Ether, which earns rewards, and it literally splits it in two. You can think of it like unbundling a stock. You're separating the ownership of the share itself from the right to receive all its future dividends. And that one simple action creates two completely separate, tradable tokens where before there was only one. Now, this split creates two incredibly powerful new tools. On one side, you have the principal token, or PT. This thing acts just like a zero-coupon bond. You buy it at a discount today, and when it matures, you can redeem it for its full face value. It's perfect for anyone who wants to lock in a guaranteed, fixed return.
Then you've got the other side of the coin, the yield token, or YT. This is where it gets fun for traders. The YT gives you the rights to all the future yield that the underlying asset generates. It's a pure bet on where interest rates are going, perfect for anyone who wants to speculate on whether yields will go up or down, and it gives you a super capital-efficient way to get leveraged exposure.
Okay, so that's the big idea. It's pretty cool, right? Now let's pop the hood and take a look at the engine that makes all this magic happen. This whole solution is powered by two key components that work together beautifully. First up, you have a custom automated market maker, an AMM. Think of it as the decentralized exchange where these tokens get traded. But this isn't just any AMM, it was built from the ground up to handle assets that decay in value over time. And second, you've got this incredibly clever tokenomic system called vePENDLE, which creates a powerful, self-reinforcing growth engine for the whole protocol. In this flywheel, this is the economic secret sauce. It is a brilliant, self-sustaining loop. So here's how it works. Other protocols, they want liquidity, right? So they bribe people who hold vePENDLE to vote for their pools. Those holders then vote to send Pendle rewards to those pools, which juices the returns. Naturally, those super high returns attract a flood of liquidity from users, and all of this creates real organic demand for the Pendle token itself, which just makes the whole ecosystem stronger. It feeds itself.
Okay, so the theory sounds great, the mechanics are smart, but does it actually work? Well, the on-chain data is, honestly, it's staggering. It leaves zero doubt about Pendle's market leadership.
First, let's just talk about the scale here. The protocol is currently securing around $10 billion in total value locked. That number, that signifies some seriously deep trust from the market. And all that capital is being put to serious work. Get this, Pendle has processed over $500 billion. That's $580 billion in cumulative trading volume. Just let that number sink in for a second. And all that trading volume translates into a powerful, sustainable business. The protocol is generating $76 million in annualized revenue, and that revenue flows directly back to the people holding the token. So this table puts it all together for you. But I want you to look very closely at that last metric. Around 40% of the entire circulating supply of Pendle is locked up in vePENDLE. That's not just a vanity metric.
That shows extreme conviction from its holders, and it's all the proof you need that the economic flywheel is spinning like crazy.
Now, everything we've talked about so far, that's just the beginning. Pendle's real, true potential goes way beyond just crypto assets. We're talking about building a bridge to the largest financial markets in the entire world.
The next frontier is tokenized real-world assets, or RWAs. This is basically bringing traditional financial assets, government bonds, real estate, private loans, onto the blockchain. And it just so happens that the exact same mechanism that Pendle uses for crypto yield is perfectly suited for this new world of tokenized assets.
And this table shows you exactly how powerful this is. I mean, just take tokenized T-bills. You could buy a principal token to lock in a fixed, government-backed yield, all of it right there on-chain. Or you could buy the yield token to speculate on what the Fed is going to do next with interest rates. Now apply that same model to real estate rental income or to private credit, and you can start to see how this becomes the core infrastructure to bring trillions of dollars on-chain.
You know, the BGVC analysis boils this whole evolution down to one critical point. Pendle started out by amplifying trends in crypto, but now it's pivoting to become something way more important. And this quote says it all. Evolving from a crypto meta-narrative amplifier to key infrastructure for the multi-trillion RWA market. That's the endgame.
So, this leaves us with one final and pretty provocative thought. As the lines between traditional finance and decentralized finance keep getting blurrier, protocols like Pendle aren't just asking a theoretical question. They are actively building the answer. A future where the world's interest rates might be transparently traded by anyone, anywhere, right on the blockchain.